coming to what an ideal portfolio construction should look like. So my view is that portfolio construction is has to be a function of the strategy that you're running. So, and when I say strategy, basically there are two or three important parameters that I look at. So one of the parameters is an average stock pick that you make. You have to sit down and think, okay, if I'm going to make a stock pick in my portfolio, what is the likely percentage upside I'm going to make in this particular script? What is the likely scenario that what is the percentage loss I'm going to make in this script? And the third factor is how sure can I be about making money on this script, right? So to give you an example, let us again go back to the small and micro cap portfolio. Let us say you are building a small and micro cap portfolio, right? Now, typically for a typical investor, a small and micro cap portfolio, the gain will be something like you are not in the small and micro cap space to make 10-15% returns. You are in the small and micro cap space because you want to make 70, 80, 100% returns or more in each stock. But at the same time, we recognize that given the nature of the space, the losses also that I can make in this particular script are very easily, it can be 30, 40, 50, 60%, in some cases even 80%. Just because I am dealing in small stocks which are very volatile and which are very which move up and down very in a very volatile way depending upon how the market is. Now with this kind of a return expectancy, if you go out and build a 5 stock portfolio, let us say, what essentially happens is you're making two assumptions here. One, that out of the 600 or 700 stocks that are available to me, I am very sure that these 5 stocks are going to, do well, right? Which is a pretty arrogant assumption. And the second is a loss in any given individual script, will not affect you psychologically, right? So if you're building a 5 stock portfolio and let us say, one or two of those stocks fall 50 or 60%, now you will be psychologically in such a bad shape that you will be forced to take the wrong decisions because you have a 5 stock portfolio because you feel you are a very aggressive investor, but the nature of your strategy is such that the stocks that you pick, they either go up 100% or they fall 50-60%. Now, with this kind of expectancy profile, you're going and building a 5 stock portfolio, then you are going to be in deep trouble, right? At the same time, the other side of it is, let us say you are, truly a conservative investor. Now, if you're a very conservative investor, and let's say you buy the kinds of stocks which are, very stable in nature, right? So you're like you buy the Asian Paint, the HDFC Bank, Lever, Nestle. You want to build a portfolio of these type of stocks, which are very robust businesses, which are very unlikely to fall 70-80%, except during a crisis. And even then, you can be sure that they will come back with the market. So if you're building a portfolio of very high quality names, then you again cannot make the mistake of, this is the opposite of what we did earlier, right? So here the mistake is to go very diversified. So if you're buying stocks where the positive expectancy or the return that you're expecting is about 20-25% or 15-25%, and the downside also is 15-25% on average. Now in such a scenario, you can afford to concentrate, right? In such a scenario, if you go out and buy 50-60 stocks which belong to the category of the Nestle's and Asian Paints and Pidilites of the world, then essentially you're wasting your time, right? So because what essentially will happen is your return expectancy is 15-25%, right? So essentially you are better off just going into an index rather than doing this exercise of concentrating with diversifying with quality, or diversifying with names where you can be very sure that your hit rate will be very high. That is, the mistakes will be very less because these are very solid businesses. And also that the possibility of losing a lot of money also is less. So in such a cases, the prudent thing to do is to concentrate, right? How much you concentrate is again, is open to discussion, whether it should be 5 stocks or 10 stocks or 12 stocks. But with a very high quality portfolio, The mistake that somebody can make is to go out and diversify massively, because that will completely defeat all the advantages that come by running a strategy which which is foolproof in terms of the downside protection, right? So these are the things. So it's very important to think about what type of strategy you're running. What type of stocks are you buying? What is your upside likely to be? What is your downside likely to be? And accordingly go about the portfolio construction. So once this basic portfolio construction is completed, then of course, you can do in for each individual stock, you can do incremental tweaks, right? So let us say, uh, let's again take the example of us, the mid and small cap portfolio, right? So in the mid and small cap portfolio, let us say you come across an idea which which is something that presently has a market fancy, right? Or it is a theme which is doing really well, or it is a theme which has an earnings tailwind. Now, if you have a 50 stock portfolio, for example, so instead of doing a 2% allocation, you can of course do a 3.5, 4% allocation for those kind of stocks, which have the other things lining up. But you cannot make the mistake of, like I said, uh, completely going lopsided with the allocation. So instead of going from 2% to 4% is fine, but you cannot have a 2% to 20%, because the moment you do this 2% to 20% allocation, the entire portfolio construction will become lopsided. So if you make a mistake in that one stock, then all the hard work that you have done in all of your other stocks will go for a toss.